Let's bring in Alan Nuckman and get his thoughts on the data. Chief Market Strategist at BullseyeOption.com. Alan, 250 is kind of that psychological threshold,
right.
I guess one could argue, but I mean, we're basically there.
Yeah, the cuts are coming. It's a fact. I mean, we never say 100%, but it looks like 100% for September. So, we are in this position, and we've been guided into this very nicely. And you look at the performance. That's how I measure everything. It's all about performance scoreboard. And the market's done extremely well. And it's had a nice little rebound from its unwind last week as well.
Yeah, here we go. We're inching our way back up to this 5,600 level. This isn't going to hurt things at all. Non-farm productivity spiking from 0.4 to 2.3, well above expectations, and unit labor costs coming off. I mean, okay, sorry, they're not coming off, but they're below what we were looking for. Half
right.
of the 1.8 quarter over quarter we were expecting. It came in at 0.9, and last reading got revised lower. So this was a pretty good number across the board. That got revised from 4% down to 3.8%, Alan. I mean, those are the directions you want to see those numbers going in, right? Unit labor costs down, productivity
right.
up.
Yeah, that's what we're looking for. And I can't stress enough how well this has been played by the Fed. Mm-hmm. Politics is one thing, but the reality of getting us to this level, if we look at the 10-year yield, you talked about pressing on that 4%.
Yeah.
That's 20% off where we were last October at 4.99. So we've been in a glide pattern down, and that's determined by traders. That's determined by supply and demand, not determined by the Fed. So that's how the markets feel that things are getting more comfortable. And is using the Fed tool to analyze, what the rate action is going to be. It's been telling us for a long time that we're going to be here for longer, not higher. So it told us what that terminal rate was. And now it's telling us that we're going to see rate cuts, obviously.
Alan, to that point, we've been arguing for a while. A big part of this market rally was just investors not necessarily too concerned about when the rate cuts were going to come, but they were pretty determined and pretty, adamant about the fact that we'd seen the peak. 5% was the peak.
Exactly. Right. And that's what the markets were telling us. And you've got to trust what markets tell you. I know you get paid to think a lot more than I do, but I trade what I see. And you can see the dollars turned over, the 10-year yield is turned over, and the markets have maintained their strength. So, I just follow what the markets tell me.
Yeah, I like to root for the underdog here and there too. So that I think that kind of may not necessarily sit well with you. But let's talk a little bit about crude oil right now, because tied into some of the geopolitical tensions, obviously there's some uncertainty in terms of what comes next, right? Iran now vowing a direct attack on Israel. I mean, this could elevate tensions quite rapidly here, and we're seeing a reflection of that in terms of price activity right back above 78.
Right. We've seen firmness, but when we talked last week, it's amazing how the sentiment on these markets have changed in just a week. We had that profit-taking pullback across the board in stocks and tech, and then we also saw it in gold and silver. We'll talk about that in a second. And crude oil looked like it was going to go somewhere when it was above the 80. It looked like it was going to attack the 85, and it didn't. So it went back down. What did I say last week? I said, all I know is this. We've been in a range for a year and a half between 65 and 85. 65 and 85. That's it. We came to the midpoint of the range. I said, let's see how we react when we get to 75. Pivot on 75. That's a level to lean on. That's a risk-reward level. Guess what? We bounced right back off that 75. So you've got to make it sometimes very, very simple, and don't try and figure out, what's happening globally. Trade the charts is the way I look at it. And obviously, there's always price pop potential to the upside with any geopolitical events. That can be a bullish catalyst at any particular time. But this is so much different than when you and I were younger. Anything that happened around the world, crude would really get bid up. It really doesn't have any reaction anymore to what happens globally.
Yeah, it's crazy how things have changed over the last 20 years of watching markets, right? I mean, a headline or any of these headlines would have sent crude $10, $20 higher. I feel like we've definitely padded ourselves from that exposure. Talk to us a little bit about how I kind of feel like crude, similarly to, as we just mentioned, the real focus for investors and traders seemed to be that peak, right, in terms of 5% back in October of last year as far as the 10-year. But crude being very much contained, range-bound, and the price activity you were just describing, I mean, that's also supportive of what we've seen in terms of stocks, right? Being padded from some of those outside influences and those major price spikes and dips that we'd seen in the past.
Psychologically, and I know a lot of people tie, the high crude prices to being negative for the economy, negative for stocks, and we've had this discussion over and over again that it's actually not true that the markets can move in tandem to the upside. A lot of times they do. So for me, it's a sign of strength. That's something to think about in the big picture. But crude, I think, is the big opportunity. Again, the PE of a lot of these energy stocks is still ridiculously low. I think this is the segment that has the most potential to the upside. And again, just a modest move, get us up to a breakout of this 85 level, is going to quickly get us to 95 and probably 105. When that happens, the longer we trade sideways, you've taught me this, the longer we trade sideways, the more energy that we build for that breakout.
Yeah, I want to get a thought on gold here as well, because speaking of sideways trading, breakouts, and trend to the upside, this commodity super cycle that you've been talking about for some time now continues here. Gold, a reflection, and the most recent recipient thereof. New all-time highs above 2,500. But Alan, you also had a couple thoughts on silver and copper, you said, which have come off a bit.
Right. Well, copper's not looking well right now. For whatever reason, it's not recovering.
Back
Whereas silver shook out, went below that 29 level, which had been a key support. And we all know silver actually emotionally more so than technically a lot of times. And so it dipped below the 29 and we're back above 29. So that's significant. But gold has been in a range between 2,350 and 2,500 for 4 months. That a breakout of that looks at 2,650. We're $50 away. What's really interesting to me is the mining stocks, and to get into the stocks related to the gold. The mining stocks still are about 5% off their highs. And if you look at the Bloomberg consensus for gold prices in the future, 25, 26, 27, they are actually declining, and they're looking for gold to be at $2,000 in 27. So they haven't caught up to that. And if gold maintains, then all of those mining stocks have great value because they essentially have the gold. So I think that's a pocket that we want to focus on these pullbacks, that the miners, any of these gold miners or GDX itself, could really benefit.
I like it. To look at some of the opportunities tied to some of these moves we're seeing in futures here with Alan Nuckman this morning, Chief Market Strategist at BullseyeOption.com. Thanks to Alan. And, well, stick around when we come back.